Tom, welcome to the show. I want to tell you, I appreciate you coming on and giving us some educations on your business of self storage and how you find these deals in distressed assets. Tom? Can you tell us a little bit about yourself and what you do?
Sure, Abiel. Thanks for having me today. I've been doing real estate in different ways since 2006 when I left corporate America. Um, and I started out like a lot of folks do, doing wholesaling and fixing and flipping and the residential side. I had a rental portfolio. Thankfully, I'm out of that business altogether. So that was a good day when I sold my last rental property. But yeah, the last few years we've been focused big time on self storage, and what we do is we find self storage facilities that are being poorly run, and we go in with our professional management team, and we turn those facilities around and really get them pointed in the right direction. So we create a lot of value over a pretty short period of time, which our investors love. So it's been a great business model. We've got a great team, so we're super excited about this space and where we are.
What regions or cities are you investing now in the United States?
Yes, right now we're mostly in the eastern U.S. We're in Maryland, Virginia, North Carolina, uh, and Georgia and Florida. We're about to put a facility under contract in Kentucky and another one in New York State.
Now, is that strategic, or is that because you have boots on the ground and it's easy for you to mobilize, or what is the
hmm
reason why you picked those cities, and how do you identify cities?
Yeah, great question. So a couple things, I guess. First of all, we are opportunistic. So when we're reaching out, we do have an in-house marketing program where we reach out to facility owners in the Eastern U.S. We have VAs that are making a ton of phone calls to these folks so we can strike a deal directly. We try to avoid on-market deals that are being brokered and auctioned because we don't want to be sucked into an auction process where everyone's having to increase their price over and over again. So we don't participate in that. We find sellers directly through our internal process, but we're trying to find facilities that are in areas that are growing. So that's why we've been drawn a lot to the southeast U.S. because that's where the population's moving. That's where the jobs are going. That's where the infrastructure investments are being made, and so we're trying to ride that wave as well. But we do from time to time have an opportunistic situation like the one up in New York State. Uh, it happens to be a growing pocket. As everyone probably knows that's watching or listening, real estate's hyper local, right? So I'm here outside of Philadelphia. This is our home base. We don't really buy around here because it's expensive, and there are pockets of growth, but they're not really popping too much. But the place up in New York State, there's a whole big development going on. There's a Costco going in around the corner, so that's just going to continue to drive housing starts. That's another thing we look for. ABL, I forgot to mention before, we look for housing starts. But that opportunity came up, and there's seller financing, and so checked a lot of the boxes. So we had to jump on that one opportunistically.
So let me go back to that what you said, that you follow the trends. What, in the housing stocks? Is that what you said? Yeah, can
Housing
you explain
starts.
that one? Oh, housing
Yeah,
starts.
housing
Can you give
starts.
me that
Yeah,
term?
sure. Yeah. So we subscribe because we are looking at the markets. We're doing our due diligence thoroughly on the markets where we're looking. One of the things we look at is housing starts. So when a home developer comes into a market and they're looking to do a project, that becomes public record. They have to file for their permits and acquire the land, etc. So the databases that we subscribe to a number of them because this is an important topic. One of them in particular tracks housing starts, so we can see if we're
Got
looking
it.
to acquire a self storage facility here, and there's a big housing development down the street over here. We really like to see that because that's going to draw in population. Population is going to drive demand for storage.
Got it. Got it. Got it. So you could kind of see that trend happening and do some sort of analytics and prediction of what you expect uh, the, they're going to consume in storages. So it's not. So you're not winging it. There's actual data that you could pinpoint and back your your returns up, which is
Oh
something that,
yeah.
yeah, in my industry, in multifamilies, I think there's just a lot of data out there, and it's easy to get. But I know that your industry is very niche. Like, it's not easy for someone like me and say, I just want to see if this is a good spot to get a storage. It takes a lot of analytics and a lot of different programs that are not out there to every investor. That's something that I've learned recently.
That's right. Yeah, no, you're spot on. In fact, we actually take a two-prong approach. We look at the supply side, but we also look at the demand side. So on the supply side, like I mentioned, we're looking at housing starts. We're looking at how much square footage of storage is in that, 1, 3, and 5 mile radius. And when we calculate what we call a supply index, which is the number of square feet per person in that market. And so the equilibrium is typically around 7 feet per person in that market. So if we run our calculation and we see that it's 15 feet, that means that we have to do a little more homework, but that there might be too much storage in that market. On the other end, if it's 2 or 3 feet per capita, we know that that market is going to be needing self storage, so we go in there. And then on the demand side, these days, of course, with technology, you can actually track in a particular geography how many people are searching self storage near
Oh,
me
wow.
on their Google on their smartphone.
That's pretty
Uh,
awesome.
yeah, so we can get a sense of what kind of hits are happening there, and get a sense on the demand side of how storage is being perceived in
That's
that
interesting.
market.
So there's a lot that goes on behind the scene. When it comes to percentage of people who are using storages, is there a science to say a certain percentage is going to be office? Like, for example, I know law firms and a lot of corporate offices need to store documents for a certain period of time, and then the other percentage, is it residential? Do you guys have a formula to identify that, or that's not a factor?
Yeah, it's a good question, Abiel. It's going to depend on the market and and the location of that particular storage facility. So we'll get a sense when we're doing our due diligence on the facility of how much is commercial versus how much is residential. And in fact, one of the big trends in our industry right now is for commercial. So contractors who they've been going through all these incredible aches and pains with the supply chain issues recently. They're actually starting to try to buy their inventory and store it so that they're not stuck on a project not having what they need.
Oh,
So,
yep.
so that's a
Yeah.
big trend in our industry right now. And then, as you mentioned, there are specialty needs like medical records or financial records. Wine,
Yeah.
cigars.
Yeah.
People can
Yeah.
go
Yeah.
all
Yeah.
different directions with
Yeah.
storage.
Yeah, I have some friends of mine that own restaurants, and they use storage facilities to store their wine and their liquor and their expensive stuff. So it's something I did not know that was used. Um, Now, what you're an opportunistic investor, and I like to say that our company is also, SCR Apartment Capital, is also an opportunistic invest. We buy distressed multifamilies. In fact, we've created a brand behind that, and we like the good, the bad, the ugly, the high vacancy, the stuff that we could get in there and start and just remodel everything and make it new again. Um, it's not for everyone. What would put someone in your business in that type of scenario, where they're distressed and you could get that opportunity to come in? What are the typical red flags what you're looking for?
Sure. Yeah, that's like you, ABL. I mean, we're not afraid of rolling up our sleeves and doing the heavy lifting. So we'll go in there and tackle those big problems like you're doing in multifamily. I think that's awesome. But the big thing that we look for is really just that the rents are well below market, and that the delinquencies are high because, as I mentioned earlier, self storage is primarily a mom and pop industry. The big names that you've heard of, Public Storage, Extra Space, Cube Smart, etc. They only control 25-26% of the market.
Mm.
So there's another layer in there of like large regional players and such, but the vast majority of self storage is still owned by moms and pops. Like a seller we
Wow.
visited yesterday, 80-year-old guy. He built this. This is his baby. He built it from the ground up, about 20 some years ago, and now he's ready to head down to Florida permanently. But the thing that happens in that
Mm.
situation, he's got his daughter helping to manage it. They get to be friendly with the tenants, and Bob's like, oh, I can't pay you this month, but I'll make it up to you next month. And they say, okay, Bob, because they've known Bob for however many years. And so they also don't want to raise Bob's rent because, again, he's a friend. And if they raise the rent, Bob might move out, and then they have to go find another tenant. And the last thing a lot of these moms and pops want to do is any kind of marketing, any kind of interaction with
Got it. Yeah, yeah,
customers. They just
yeah,
want that mailbox money. And this guy has much said that to us. He's like,
yeah,
yeah, I could raise my rates for sure. I see where they are, but I don't
yeah,
want to do that. I don't want the hassle. I don't want the headache. I like
yeah.
the amount. He said, I like the amount of money that's coming in. So to us, even though it's a beautiful facility, to us, that's a sign of distress, or maybe not severe distress, but certainly a sign that it's not being run as efficiently as it could be by a professional organization like Belrose Storage Group.
Got it. Got it. It's crazy. I do see a lot of that in our business, same where you have managers or just managing assets in real estate after 20 years, it does take a toll on you. Or what I see a lot is you get blinded and you're set on your ways, but you miss out on all the opportunities and the bump ups that you can get. And like you mentioned, having the technology or be willing to pay for marketing. I find that so hard for a lot of investors or even small mom and pops to pay $4,000 or $5,000 in apartments.com a month for a property. They're like, that's insane for them, but they don't see the return and the
Mhm.
traffic that's going to generate and the
Yeah,
quality of tenants or quality of your tenants that you're going to begin because you're on the top of the search engine. We all do that. We just go and
that's
grab the
right.
first top three. No one goes to the third or fourth page of Google. So
That's right.
paying for that, there's a value to it, and also on the quality of the person. So I could see that opportunity where you're finding them. Um,
Hmm.
Now, are you in the space of looking for conversions? I keep hearing a buzz. I mentioned to you that my first diversification into a storage. I've been 100% in multifamilies, and your business has been catching my eye. I invested recently on a land in Palm Beach that's gonna be developed for a storage, and came in as an LP on it. I'm just going to sit back and watch it, not active at
Hmm.
all. We invested with an investor's invested in our multifamilies, and he's an expert at this, but he builds them from scratch. And it was very interesting how he did his research and how he found it. So I am strongly a believer in that. Now, there's also conversions of offices that I'm hearing that's going out there. Are you
Hmm.
looking at those opportunities?
Uh, yes and no. So our bread and butter is finding existing facilities that have value add potential. Now, some of that value add might be converting an existing building on the property into storage. So we're doing that at a couple of our facilities.
Yeah.
And then, of course, another value add might be building a new section on the property if that would allow it. But no, you're spot on, and that's one of the reasons self storage is becoming more popular is because it's no longer that kind of rusty, dusty metal box back in the industrial area. We're seeing. In fact, we were involved in a deal where an old Sears store, was being converted into storage. We found the lead, but we brought in some partners because that wasn't our bread and butter. It wasn't our strength. So we just let them run with it, and we ended up making a nice fee. So that was great.
You got it.
But the Best Buys, the old Kmart's, all those
Kmart's, yeah.
things in those retail areas that are going to be more in kind of the moms and dads day to day errand running when they're going to Home Depot, the grocery store, wherever. They'll be able to hit that self storage facility that's going to be right in that strip center, right at that mall.
As an investor, what risk should I be looking for when I'm investing with a syndicator in storages? What are my red flags? What should I look for? What questions should I be asking someone like you?
That's a that's a great segue, Abiel. One of the things, if you don't mind me throwing out a small commercial, so
Yeah,
belrosestoragegroup.com, we have a resource on there. It's called the Safe Investing Method, and I was actually going to plug it a little later, but I'll go ahead and plug it now
nice.
because
We could drop if you have a link. Yeah, I'll drop a
yeah.
link so they could. Yeah,
So basically, this is an ebook, which is a compilation of all the mistakes that I've made over the last 16 years as an accredited investor myself. But it's called Safe Investing, and Safe is an acronym. It's sponsor, asset, financials, and exit. So in the ebook, it gives you a whole list of questions to ask about the sponsor who's running the deal. What does their net worth look like? What is their experience? What's their background in this asset class? Have they gotten in any trouble? What's
yeah,
their team like? That kind of thing. It helps to avoid, investing with, Joe Syndicator at gmail.com. I mean, you want to see like there's an actual
yeah,
company there,
yeah,
right?
yeah,
Of course, for asset. So you want to know what is the asset you're investing in, the multifamily building that you're looking at, the self-storage facility you're looking at, what do those markets look like, that kind of thing. F is for financials, which is, what do the financial projections look like? What do those ratios look like? I'm a finance nerd by training, so I look at all that stuff, whether it's our deals or deals that I'm looking to invest in as a limited partner. And then E quickly is exit, which is how do I get out of this thing? It's not like you can go to schwab.com and click, sell your shares in a Belrose Storage Group self storage facility syndication because it's that level of liquidity is just not there. So you have to be comfortable as an investor being tied up in that asset for 2, 3, 4, 5 years, whatever the plan is. So, but yeah, it's getting the right sponsor. ABL is job number one for sure.
key. I agree with you 100%. What is your typical return projections on a deal?
Yeah, so we're targeting when we run our underwriting and we look at pricing a property, we're targeting uh, the high teens for our limited partner investors. So 17, 18, 19% is what we target. Now, based on my background, I've always been very conservative with our underwriting. So to this point, we've exceeded that hurdle on every deal that we've done so far,
Is
and the deals that are in our pipeline are also trending in that direction.
is that IRR or annual average return you mentioned, or
It's IRR, yeah. Mhm.
IRR? Got it, got it. And your typical deal is 3 to 5 years, but do you go past the 5 years, or that depends on market conditions, or
Yeah, it generally it depends, but I would say we typically would not go past 5 years unless there are some
got
special
it.
circumstances. Because again, we're a value add player, so we can typically capture the bulk of that value opportunity in the first few years, or if not
Got it.
sooner.
How much does an investor need to start off with you?
So yeah, good question. Our minimum is typically 50,000, but because we are in growth mode, we're trying to grow our investor database. We're actually lowering that to 25,000, just because we know that investors sometimes, back to your question a minute ago about the sponsor, if they're not really comfortable yet or they don't quite
Yeah.
know you, give them an easy way to take a little test drive, and then hopefully that 25,000, the next deal turns into 250,000.
Yeah, 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 definitely. Do you have a deal right now that you're under contract that you'd like to explain to us and pitch?
Almost. I'm very
Almost.
close.
All right. Okay, okay.
Very
Good,
close,
good.
but I
Okay.
do. What it's funny, when you're putting your business plan together, you're like, okay, we're going to do one acquisition a month, and never works out that way, does it, ABL? So we're
No, it
actually about
doesn't.
to
It
put
doesn't.
3 deals under contract. So we've
Yeah.
got a lot of money to raise over the balance of the year. So anyone out there
No,
listening who's interested, come
your
find us. We
business
can.
had your business has become very popular now. I'm pretty sure 15, 20 years ago it wasn't this competitive, but now, same as mine. And I think that the syndication model has gone very mainstream with social media. Look at us, we're having a podcast talking about this now. So
Right.
and it's not because it's a trend. It's because it's lucrative. It makes sense. It makes
Mhm.
money. It's safe. there's a
That's
lot of
right.
positive factors about both of our industries that are becoming popular. People are more open about it. It was, like you said, mom and pops are the only ones that were taking advantage of these things for very long. And
Mhm.
now people are like, okay, now I can invest in these, and you don't have to get your hands dirty. You can invest with someone like you, then where you could give it to a professional. So
That's
I do
right.
see the value in your business, and diversification from multifamily to storage is a trend that I'm going to start doing personally in my life. So
Yeah.
I look forward to speaking to you in the next business that you do. Tom, you gave us great insight about your business and how you run it, and you seem to know very well what you're doing. Is there anything that you would like to say? And drop a link, or how can the listeners
Yeah,
listen?
I appreciate the opportunity to be with you and listeners today. I would encourage folks, if you want to learn more about Belrose Storage Group or our upcoming opportunities, you can go to belrosestorategroup.com. There you can pick up your Safe Investing ebook, but you can also register on our investor portal. And folks that are registered on our investor portal are first to learn about the opportunities that we have coming up. So, like I mentioned, it's a little too early to talk details about them, but we do have three
Okay,
that are coming up very soon. Very
that's
soon.
awesome, man. Good luck, man. I hope you get those three. Tom,
Thanks very
thank you
much.
for your time. Thank you for everything. Appreciate it.
Thank you, Abiel. It's great being with you.